Good evening from Kuala Lumpur, and welcome to the first day of this joint conference with the Bank for International Settlements on digital disruption and financial inclusion, challenges and opportunities. My name is Aish from the Republic of Maldives, and I am a Master of Central Banking student at the Asia School of Business. We will begin shortly, but first I want to invite you to use the Q&A function at the bottom of your screen to ask questions. I would like to remind you that there will be some time allocated for questions toward the end of our first session. Please use the Q&A and not the chat for questions. You can also like other people's questions, which will push them up the list. It is my honor to introduce to you our chair for the evening, His Excellency Governor Perry Wajio, who has been the governor of Bank Indonesia for about 4 years after serving as deputy governor for a further 5. As well as 30 years of experience at Bank Indonesia, he was on the IMF board during the global financial crisis. Indeed, Governor Perry has been described as battle-tested as central bankers get. Now, without further ado, I give you your chair for the evening, Bapak Perry, Governor of Bank Indonesia.
Thank you, Ais, for the kind introduction. Indeed, it's a great pleasure for me to chair this ASBBIS joint conference with the most pressing topic of discussion on digital disruption and inclusion, challenges and opportunities. I'm well aware that we will be discussing various compelling subjects throughout this conference. I think that our session today will be the perfect setting ground to kick off the conference, as we will hear firsthand experience and success stories from our fellow governors and former governors in the region in being a frontier in digital payments and digital credit to achieve the financial inclusion. We hope that by the end of the session, we can all leave the meeting with a more comprehensive understanding of the elements of successful digital innovation as well as digital transformation. Before we begin, I will now have the honor to introduce Dr. Zedi Aziz, who has been since 2018 the co-chair of the Board of Governors of the ASEAN School of Business in collaboration with MIT Sloan and the PNB Group chairman since 2018. Dr. Zedi Aziz, a career center bankers, which is I always adore and also look for her guidance. Served as the governor of the Bank Negara Malaysia for 16 years, from May 2000 to April 2016. She had an important role in successfully managing the 97-98 ASEAN financial crisis and the consequential strong economic recovery of the Malaysian economy. She also oversaw the transformation of the Malaysian financial system in the decade that followed, thereby building the resilience. She was unrelenting in working for ASEAN and East ASEAN regional financial integration. She also worked in various capacities to strengthen regional financial cooperation and collaboration. She was also a voice for the emerging world on many issues concerning the international financial system and on financial and economic management. Dr. Zedi holds a doctorate in economics from University of Pennsylvania. So without further ado, Honorable Dr. Zedi, I invite you to take the virtual floor for 5 minutes to deliver the opening remark. Dr. Aziz, please.
Thank you very much for your kind words. It is my honor here to welcome my dear friends from the central banking community and the participants from all over the world who have joined us. This conference on digital disruption and inclusion, challenges and opportunities is organized, as mentioned, by the Asia School of Business in collaboration with the Bank of International Settlements. Greetings from us from Kuala Lumpur. The current environment is seeing several major disruptive developments that the world has never seen before, both in terms of their nature and scale. These changes have brought with it wide-ranging transformative changes that have presented central banks with new challenges. And this conference focuses on two of these disruptions, that is digital disruptions, and secondly, on the rising inequality that is going on since this pandemic, global pandemic, and the potential, of course, to leverage on the digital disruption to achieve greater inclusion while managing its associated risks. Central bankers, while focusing on macroeconomic stability and financial stability, have also started to focus on the ESG agenda. Our chosen today focuses on the S, the well-being of society, that is the inclusion agenda. In essence, to discuss the potential to leverage on digital disruption to address the inclusion agenda. From my experience of having been a lifelong career central banker for more than 3 decades, the formulation of any policies needs to have 3 elements. Firstly, it needs to be anticipatory and preemptive. Being reactive after the fact would render the policy to be less effective. Secondly, in a highly interconnected world, policies need to be comprehensive and not piecemeal. Most often, policies need to be supported by other policies that will provide the enabling environment and that will also reinforce the original policy. This is particularly true for emerging economies that may not have the institutional arrangements already in place. Thirdly, and finally, in a highly dynamic environment, there needs to be also a close monitoring of outcomes generated by the policies. This is to ensure that the resulting outcomes are in accordance with the desired objectives being envisaged. Our journey for the inclusion agenda in Malaysia has been accompanied by the institutional arrangements for example, for the mechanisms for addressing associated challenges related to the inclusion agenda. And this includes the financial literacy, advancing financial literacy, having arrangements for for dealing with greater indebtedness by households and small businesses, and then having in place the regulatory and supervisory oversight to avoid predatory behavior in the financial system. And these are some of the institutional arrangements and mechanisms implemented in Malaysia. So in conclusion of my remarks, I wish to take this opportunity to thank the BIS in particular, Augustin Carstens, for his leadership in the central banking world, and today for the BIS collaboration in the organization of this conference. I wish also to express our deep gratitude to Her Majesty Queen Maxima of the Netherlands, from whom we will be honored with her address at our conference tomorrow. Her Highness's global commitment to the inclusion agenda for more than a decade has been of immense inspiration for all of us. Finally, to all the speakers that have come from the BIS, the central banking community, from the MIT faculty, in particular, Nobel laureate Professor Robert Merton, and to the personalities from the IT industry, I wish to express our heartfelt appreciation for your participation at this conference. And of course, to all the participants who have joined the conference, thank you for your participation and wishing everyone a most productive and successful conference. Thank you very much.
Thank you, Dr. Zedi. Editor, very introduction. Next, I will invite the General Manager of the BIS, Mr. Augustine Carson. Augustine became the General Manager of the BIS since the 1st December of 2017. He holds an Master of the MA and PhD in Economics from the University of Chicago. Mr. Carson was governor of the Bank of Mexico from 2010 to 2017, a member of the BIS board from 2011 to 2017. He was chair of the Global Economic Meeting and the Economic Consultative Council from 2013 until 2017. He also chaired the International Monetary and Financial Committee, the IMF's Policy Advisory Committee from 2015 to 2017. He began his career in 1980 at the Bank of Mexico. From 1990 to 2000, he was executive director at the IMF. He later served as Mexico Deputy Finance Minister 2003 and as Deputy Managing Director at the IMF 2003-2006. He was Mexico Finance Minister from 2006 to 2019. Mr. Carson has been a member of the Financial Stability Board since 2010 and is a member of the Group of 30. Agustin, please, your 5 minutes.
Thank you very much, Perry, for this kind introduction and to having you in this conference. And of course, let me start by thanking Seti Assis, Dr. Seti Assis, for her inspiration and drive to organize this conference, and more than anything, to thank her very much for all the work she's doing at the Asia School of Business, having very much in mind to deepen the education and human capital related to central banking and financial authorities. It's an admirable project, and we wholeheartedly support it. And I join her in thanking all the participants and speakers to this event, and in particular also to Queen Maxima that will be here with us tomorrow. And definitely I wished when we first talked about this conference, I had a very high expectation to be in Kuala Lumpur for it, but regretfully, given conditions, it was impossible to travel. But I hope that in some other occasion, we can do it in presence there in Kuala Lumpur. So this conference is about the long-standing objective of fostering financial inclusion in the context of unprecedented technological development and disruption. The inclusion objective, I should note, is not only about access to a bank account, but also about using it for payments, savings, or borrowing, and using it responsibly. The new development is digital technology in finance. The use of technology per se is not new. We can remember that the first ATMs were introduced more than 50 years ago. It is a rapid pace of change that really is new. The marriage between digital technology, big data, and finance is fast creating opportunities for greater inclusion. As we will discuss today, it can help societies, especially their excluded segments, to leapfrog ahead. For example, online Know Your Customer can make digital inroads that reach the financially excluded. Access generates data that, when properly used, can reduce reliance on collateral. All this can make more products available to those already or recently included, from savings to investments and from borrowing to insurance. Yet there is a risk that some may be left behind, exploited, or losing the race. Those who cannot buy or use smartphones may be left behind. Those included in the traditional sense may become dropouts in the digital sense. Even the experienced ones may be exploited via algorithms that identify behavioral biases. And are the risks to those piling easy debt or buying property in the metaverse well understood? The session tomorrow focuses on these issues. It is hard to predict or control how technology will evolve, but we can influence how technology reshapes finance and strive to ensure that it benefits all. The vision I have is for an open financial system built around a public-private partnership. The public sector would provide the game board, i.e. the infrastructure, and the rules, i.e. regulation and supervision. Private players would provide the new ideas and compete to the benefit of end users. Public institutions exist to serve the public. The trust they inject in the system is the anchor of society's confidence amid rapid change. The robust game board with fair rules they provide can ensure competitive play, avoid concentration of data, and mitigate rent-seeking. Consent-based data governance would give users control of their data, and the dynamic ecosystem would constitute the perfect breeding ground for innovation. To harness benefits and minimize risks, policymakers must share with each other which solutions work and which do not, as the third session of the conference will elaborate on tomorrow. The BIS and the BIS Innovation Hub also offer forums to share knowledge and experiment. Let me close by stressing that truly inclusive finance in a rapidly changing world means ensuring equitable access and responsible use for all. One way forward is to work towards an open financial system with public-private partnership at the core. Certainly, I'm looking forward to hearing the insights from the excellent lineup of participants we have, many of them colleagues of mine as central bankers and very distinguished former central bankers, and with a very good mix of participants from academia and from civil society. So thank you very much for the opportunity to participate in the organization of this event with the Asia School of Business. And thank you very much for devoting some time and effort to this very important topic of financial innovation in the context of digital disruption. So thank you very much. I give the floor back to you, Perry.
Thank you indeed, Augustine. In the interest of time, let me welcome our keynote speaker of this session, Mr. Siddharth Tiwari, who will be delivering his remarks on virtual banking and beyond. Mr. Tiwari became Chief Representative of the BIS Office for Asia and the Pacific since 1st November of 2018. Before joining the BIS, Mr. Tiwari served as the Executive Secretary to the G20 Eminent Person Group on Global Financial Governance from 2017 to 2018. From 1985 to 2017, he was at the IMF, where he assumed a top-level position at the fund overseeing the works on the strategy, policy, as well as lending operation. He also has significant experience in international policy making and cooperation, including on issues of great relevance to the Asia-Pacific region. He earned his master and doctorate degrees in economics from University of Chicago. All the questions will be saved for the last part of the session, and the participant can post the question on the Q&A box. So, Mr. Tiwari, please deliver your keynote speaker.
Good evening, and thank you, Pak Perry, for the very kind introduction. This evening, I'm going to present an overview of some of the work done in the Asian office on the new landscape of digital finance. A lot of this has been done in collaboration with Nandan Nilekani and his colleagues in Bangalore. And so I will bring to you some of what he would have brought, but of course, he would have been infinitely more eloquent than what I would be. So let's move on with the slides, and I have a set of slides that I will go through. My main messages today are going to be threefold, and they're going to appear again and again as I go through this presentation. The first, that technology, when harnessed properly, has the potential to leapfrog traditional evolutionary processes, and the financial sector is no exception to it. When it's properly framed, economic systems have the potential to ensure that regulation and innovation are complementary and not competitive. And third, what Augustine said before, that the architecture of public-private partnership delivers significant benefits to society, to businesses, to consumers. Everyone is better off. Next slide, please. In the last decade and a half, technological innovations have driven three developments in finance. One has been using technological protocols to bring more individuals into the financial system, largely around providing underlying conditions for individuals to get bank accounts. So that's been one. The second has been the increased ability to use data to serve the underserved, both individuals and small businesses. And third, which is gaining ground, is the increased ability to harness data to ensure that the parties who created the data, to whom the data belongs, can benefit from it. I'm going to take examples from India in going through all of these points. So let's move to the next slide on the first example of leapfrogging evolutionary process. So to frame the financial inclusion channel, it's a well-established regularity that financial deepening goes hand in hand with economic development. A similarly strong positive relationship between economic development and financial inclusion has also been suggested by the World Bank database. That's the black fitted line on the left side of this chart. At the same time, it is also increasingly recognized that identification, or IDs, is one key element for financial inclusion. And you can see on the right side that there's a strong positive relationship between the proportion of population with ID and those having a bank account. As people obtain such verifiable identities, they also have an easier time opening bank accounts, obtaining credit, and enrolling in social welfare programs. In the left panel, we've picked up 2 points of time, one 2008 and then 2017. Given the low level of both financial inclusion and formal identification in 2008, the magnitude of challenge facing India a little more than a decade and a half ago was clearly immense. Based on the bank account data in the relationship with GDP, one rough estimate is that it could have taken well in excess of 40 years to achieve 80% of adults with a bank account had India solely relied on traditional growth processes. The question that's asked again and again is how this was achieved. And there are two important building blocks on this. One, as this graph illustrates, identity. And second, a payment system that is available. On identity, Aadhaar is a biometric identity that requires minimal information and has a low marginal cost of. It consists of a 12-digit random number that corresponds to certain demographic and biometric information of an individual. The mandatory information to be provided is, as it shows on the screen, is 4 data points: name, date of birth, gender, residential address. In addition, the user provides a photograph of the face and biometrics, which is fingerprints and iris scans that can authenticate the user's identity when the number is used. As a general purpose identity, it is usable across a broad variety of functions, increasing consumer convenience and lowering transaction costs. When I last looked at it, over 99% of the population is enrolled, close to 1.3 billion people. The use of biometrics is unique to the individual and reduces the possibility of misuse. That's the first building block. Next is the payments rail in India, UPI. UPI allows for a wide range of methods for customers to transfer funds within the system using the virtual payments address, a UPI ID, a mobile number, a banknote with a bank account, or simply the Aadhaar number. The system operates 24/7, is instant, costless, frictionless, straight through, enables funds to move from C2C, C2B, B2B payments. UPI is interoperable. It enables individuals to use a single bank or payment service application to manage money residing in multiple bank accounts. It has open and contestable entry. Any regulated payment service provider can directly use UPI to transfer funds between individuals, bank branches, point of sale machines. Fintech and big techs can also ride on the UPI rail through regulated payment service providers. The UPI platform is regulated by the Reserve Bank. Importantly, transactions settle in fiat money inside the regulatory framework. And this being an example of a technological innovation which is big tech, fintech, private sector friendly, but settling in fiat money within the regulated system. The government has extensively used the UPI system to conduct fiscal operations. Supported by the rollout of Aadhaar and UPI, World Bank data shows that about 80% of the adult population had bank accounts in 2017, the last year for which this data was available. Also shows that it was the largest increase in the sample of 121 countries that were looked at between 2008 and 2018. I looked at the numbers yesterday for December. There were 282 banks operating, with UPI doing 4.5 billion transactions in December alone, and you will get a good description of this tomorrow with Dilip Apse. So what has all that done? Next slide, please. In closing the inclusion gaps, what is unique about this is that the increase in financial inclusion at the aggregate level was accompanied by a sharp reduction of the marginalized groups. The gender gap between men and women, the employment gap between those in and out of the labor force, the education gap between highly educated and less educated, and the income gap between the poorest 40% and the richest 60%, all reduced significantly, exhibiting access widely to the payment system. Next slide. Impressive that these gains are, more work remains to be done to ensure, Jenny, it's one slide before this. Impressive that the gains, slide 7, right after this. Yeah, that's the one. Thank you. Impressive that the gains are, more work remains to be done to ensure that broad-based access to financial intermediation services are available. As you see on the slide, the proportion of people who borrow funds from the financial institution in any 1 year are quite small, around 11% on average. This is not an emerging market, developing country issue. If even in international financial centers such as Hong Kong and Singapore, where there's near universal bank accounts, universal mobile penetration, high income, highest PISA scores, high financial literacy, large percent of the population in the financial sector, and large portion of GDP emanating from the financial sector, these numbers are low. As Augustine had mentioned before, one key reason appears that tangible collateral is still key to lending, and the reliance on collateral leaves out the underserved. The young don't collect collateral till later in life, and the poor never do. A second reason is, of course, that the low margin customers are too risky for banks. Technology offers insights on how to deal with these intertwining challenges. Next slide. So the technological developments during the last 2 decades have made increased use and analysis of the ever-expanding data resources much cheaper and more efficient for several reasons. One, smartphones have ushered unbounded possibilities. 2, the consumer's digital footprint has expanded as the number of touch points have increased dramatically, aided by high-speed internet networks, high network connectivity, and as I mentioned, smartphones. 3, the larger footprint led to a large explosion in the availability of high-quality data. 4, as the volume of data increased, technological innovations such as cloud computing have led to a large drop in the cost of permanent storage with real-time global accessibility. And 5th, the combination of ever-expanding consumer footprint, increased availability of data, cheap storage has provided the foundations for high-performance computation. Real-time computation and communication between humans and machines and between machines, combined with intelligent human interfaces, have provided the groundwork for algorithms work based on artificial intelligence, machine learning, and deep learning, which are outperforming all previous algorithms. Information captured from the everyday online activities of individuals creates information capital that reduces the reliance on physical collateral. Look at the last column on this slide. the supply of data, which gives an indication of the inputs that go into information capital. Data in firms that can manage data, which means banks, fintechs, big techs, will be at the heart of this transformation. Next slide, please. On the evolution of the banking stack with the advent of technology, you are able to see that on the right side, all the activities that were either done physically or analog are now being done through a digital means. The greater adoption of technology focuses the heart of the new banking model on the use of data. As more consumers go online, the more popular applications attract more traffic and generate more data. Advances in technology, including real-time computation and AI, have enabled enhanced monitoring of user interests, spending patterns, and payments behavior. This allows banks to offer more tailored products to their customers, both individuals and firms alike, which in turn attract new customers, generates new data, and creates a virtuous cycle. In the credit, these valuable data can be used for the purpose of credit assessment, monitoring, and enforcement. Next slide, please. So this is a slide that normally tests one's eyesight. We tried making it easier, we didn't succeed. But here's a sample of the virtual banks in Asia. And the common feature is that they offer an enhanced digital experience that encompasses other parts of the consumer lifestyle, including social media and consumption. These are services that are typically not yet available at a traditional brick and mortar bank. This approach is seen as being crucial for creating a digital ecosystem that builds up a user base over social networks and helps create a large volume of data points for analytics. Another notable feature here is the reliance on technology for cost reduction. Technology affects not only consumer interface such as onboarding, but also key operations such as transaction speed, risk and analytics, and risk mitigation. Banks without a legacy technology system have emerged to meet the immediate market needs. Data from these virtual banks suggests sizable reduction in operating costs. This cost reduction and the ability to operate at a low revenue to user ratio is crucial for reaching the underserved. Digitalization enables banks to incorporate a range of technologies that we talked about. Digital platforms show evidence of expanded financial inclusion, reaching out to women and younger users, two of which have been traditionally underserved groups. Next slide, please. By now, it's quite clear that these developments provide challenges to financial regulators. Regulators must ensure that oversight of the new financial architecture that relies on information capital delivers on inclusion benefits without compromising the solid regulatory goals. In Hong Kong, the virtual banking experiment is fully underway. Basic licensing requirements are one tool in this regard. Jurisdictions can ask that virtual bank applicants submit a detailed and credible business plan that explains how virtual banks intend to comply with the objective for financial inclusion as well as innovation, while the licensing requirements for banks such as risk management, control systems, and fitness of senior management should apply, sufficient technical expertise and experience in the board and senior management is another requirement. Subjecting virtual bank to a holding company structure where the holding company must comply with pre-prudential requirements that a bank is normally subject to is one prudential approach adopted here. When the owners of virtual banks are diversified conglomerates, the focus on the holding company helps the regulator to obtain the relevant information to assess potential risk. Another set of challenges relate to technology-related business models. Fintech often results in rapid scale-up of operations. Regulators focus on ensuring that the pace of growth of digital banking is not so rapid to strain the system. They require banks to develop an exit plan to unwind in an orderly manner without disruption to financial stability. Use of data, of course, comes with risk. Data is backward-looking. It has not seen a full credit cycle, and on default, information capital has no tangible benefits to banks. Systems, models, and algorithm governance issues prevent challenges as well. It is by now well known that certain biases are embedded in financial inclusion. At the same time, there's a pressing need for a data governance framework where consumers and businesses can control the data that they create. I'll move on to the last section, which is on data governance. And the question here is that globally, most countries have laws that recognize the rights of individuals over the data that pertains to them. These laws give data subjects the opportunity to exercise control over the data through either the granting or the withholding of consent architecture. However, consumers find it difficult to effectively exercise this consent for three reasons. One, a service provider usually seeks consent from a user at a time when the consumer agrees to participate in the activity. I don't know about majority of you, but when I agree to an activity, I scroll down 18 pages and I hit I agree in under 30 seconds. Second, consent is sought ex ante for a wide range of possibilities. It is broad and sweeping in nature. And third, in many cases, consumers do not understand the benefits and the costs of the data. Inaccessible data, including data in walled-off silos and owned and operated by big tech firms, represents a significant cost to consumers and society. A de facto and productive control of data to consumers and businesses can be restored by requiring consent prior to the collection, sharing, and processing of data. Next slide, please. In these areas, there are 5 standards for data sharing. One is purpose limitation, to collect data for the purpose it is needed. Data minimization, only collect the amount that is needed. Limitation of retention, to only ensure that data is not retained for longer amount than the stated purpose. Use limitation, the obligation to ensure that data is only used for the purpose that it was collected, and then operational resilience. Jenny, I think your slides are not on. We can go to the last slide. I will skip slide 14. Let me just talk through it if the slide is not on. The state-of-the-art consent mechanisms are built around what are called the organs principles, that the system be open, it be revocable, that it be granular, that consent is provided in a granular fashion just before data is shared. Granular consent satisfies the purpose limitation, data minimization, limitation of retention and use limitation that I talked about, that the system be auditable and notice be provided to the users. And finally, that the system be secure, given the granularity of data sharing requests, the enormity of data involved, and the possibility of being spread over several data users and data providers. The system needs to be digital to meet these requirements in a cost-effective manner. I've run out of time, so I'm going to stop here. Coming back to where I started from, that that technology has the possibility that harnessed well to leapfrog traditional evolutionary processes. When properly framed, regulation and innovation is complementary, and public-private partnerships deliver significant benefits that we've seen. Back to you, Pak Perry.
Thank you, Tiwari, for this excellent presentation. Indeed, we're talking not only not the digital disruption, but digital innovation. That digital innovation is good for the inclusion. I think that's what Tiwari already mentioned. What we need to be done for digital innovation to be supportive for inclusion. First, of course, we need a clear ID, security, biometric, so that can reach out the most unbanked people. I think that's one of the things. Second, we need also unified payment integration, interoperability, which is unified payment interface. So interconnection is important. The third is also important, the transformation of the banking to be digital. Not digital banking, not bank, but also transformation of the banking to provide services through digital, virtual. The fourth is about data, about privacy, ID, security. But the fifth, this is the most challenging, the regulatory and the policy. How the regulatory and policy need to balance between the fast-moving digital innovation, but at the end, also risk mitigation of the privacy, of security, as well as also how to cyber threat. I think those are the 5 things that we learned from Mr. Tiwari. And then this is the fruit of this discussion for tonight. Let me just go into more deep, which is the empirical works on how digital transformation innovation can reach out the most unbanked people. So next, let me invite our speaker, Mr. Sumit Agarwal from National University of Singapore, to present his work on the inclusive finance model. This will add an excellent academic background to our discussion today. Mr. Sumit Agarwal is a Lo Tak Wong Distinguished Professor of Finance at the Business School and a Professor of Economics and Real Estate at National University of Singapore. Previously, he had position as a Professor of Finance at the Business School, Georgetown University, a senior financial economist at the Research Department at the Federal Reserve Bank of Chicago. And prior to joining the Chicago Fed, he was a senior vice president and credit risk management executive in the Small Business Resolution Group of the Bank of America. Sumi's research interests include issues relating to financial institutions, household finance, behavioral finance, real estate market, and sustainability. He has published over hundreds research articles. Mr. Agarwal will focus on his published paper entitled Banking the Unbanked. What do 255 million new bank accounts reveal about financial access? Mr. Agarwal, the next 30 minutes also on your presentation, please.
Governor Perry, thank you very much. Let me share my slides. Okay. Can you see can everybody see the slides? Okay. So I'm going to talk about models of financial inclusion. I have 3 models that I have worked on over the last couple of years. The first is looking at the Jan Dhan Yojana plan in India that actually included around 280 million people to be banked from being unbanked. This is kind of dovetailing what Siddharth was talking about earlier, where he said, look, we started out with a very few people being banked in India, and then it went to 80%. And how did that happen? So this is like taking one of Siddharth's slides and really spending next 25 minutes explaining how did that Siddharth slide show that big jump and what are these people doing with that money. The second model I'm going to talk about, if I have time, is to talk about Rwanda, where they actually had these small MFIs and how they actually did financial inclusion. And that actually created people from not only going from unbanked to banked, but actually moving on to formal banking. And if I have any more time, I'll talk about the role of fintech. This is where Siddharth was dovetailing to his later presentation and the role of technology. And I'll talk about how financial inclusion is helping maids in Korea actually take advantage of fintech in transferring money back to Philippines or Indonesia or Malaysia and various countries, and how they're actually using networks that they're forming within this fintech app to save money on exchange rates, but also to figure out what is the right I'm going to mostly focus on the Jan Dhan Yojana of India, but if I do find time, I'll talk about that. So this is what Siddharth mentioned, but I'll kind of just briefly touch over it. There is a big debate on the impact of financial markets on consumer welfare. In developed countries, the debate is mostly about financial markets. Are they too large? Are they too complex? In developing countries, the big debate has been on financial inclusion. And rightfully so, because most of the people across developing countries don't have actually access to banking. G20 Financial Inclusion Action Plan said access to finance provides stability and progress to families, businesses, and the economy as a whole. We know that around 450 million people in India don't have access to finance in 2013, and over 2 billion people around the world lack access. So there is a long literature in financial development and growth. This is also Siddharth touched on it, that there is this correlations people have talked about. But what is less known is the impact of financial inclusion programs on the households and the broader economy. And that's where we will kind of come in and talk about what is the role of financial inclusion. So what do? We will evaluate the largest financial inclusion program in the world, where we'll first look at micro data to assess whether the program's impact on the initial uptake, which is the extensive margin in my mind, and the subsequent usage of banking services by the poor. The second thing I will look at is to examine the determinants of bank account usage and access to credit. So you're getting this bank account, but does that then give you access to formal credit through the banking channel? And the third, I will look some regional variation in the program exposure to study if the JDY program had other broader economic outcomes such as lending, consumer expenditure, and so on and so forth. Okay, I will not do any welfare analysis. That's just beyond the scope of what the data will allow me to do. Okay, so just to briefly give you a preview of what I'm going to show you, that banking usage was initially low because of the Jan Dhan Yojana program, but it went up to 75% of the bank accounts had positive balances, and deposit inflows were around 0.8% of the pre-program deposits. There could be three motivations why people are actually putting money in the bank account and using it. One could be just safekeeping, that it actually is safer to be in the bank account. Women keep it because the husband will otherwise take it. He comes home, he's drunk, he'll just say, give me the money. So that could be one idea. The other idea could be liquidity management, that saving up is in good times and falls during bad times. So people go save this money in the bank account during the good times, but they withdraw this money when they really need it. So this is about liquidity management. And the third motivation could be access to credit, that this allows you to build credit, and that allows banks to give you credit. So I'm going to try to kind of tease out what could be the motivations for why people actually use these bank accounts who are unbanked, and does it have really a big impact? And then I'm going to talk about the aggregate credit data and look at differential increase in lending in ex-ante unobserved regions. So which areas are getting more credit because of this Jan Dhan Yojana? So essentially the regional analysis, what I will try to show you is there is new lending that happens because of Jan Dhan Yojana. Obviously, the new lending is higher default lending because they're giving it to the marginal borrower, and the marginal borrower clearly is risky borrower. So, but that's good. I mean, banks are taking on risk. They're giving to the marginal borrower. They're defaulting as long as they're pricing the risks appropriately. That's perfectly fine. I'll also show evidence that this decreases consumption volatility in the ex-ante underserved regions, which is a great thing because consumption volatility is a big concern for consumers. What do I mean by that? Consumption fluctuates quite a lot over time within a person. Instead, all the models we know in economics are about, consumption to be smooth through the business cycle or through the life cycle. And if there's huge volatility, that creates uncertainty and that creates less motives to save for consumers. And then I will try to see why this is happening. Is it ex-ante lack of banking supply to the target population or profit seeking that is causing these things? Is it low deposit inflows or low credit worthiness? Okay. So let me try to talk a little bit about this largest financial inclusion program that happened. This was launched in August 2014. Essentially, it had 5 features in it. It said universal access to basic banking services for all Indians. We will provide bank accounts with overdraft facility of around 5,000 rupees. I mean, when you start converting these to dollars, numbers will become tiny, but I rather focus on what is it in Indian rupees because that's more meaningful for the Indian population. After 6 months of usage, it also provides accidental insurance to all bank account holders and life insurance, those who opened the account by January 2015. It allows you to have banking, online, mobile banking and insurance and pension schemes in the second phase. So it was quite comprehensive. Clearly, there was this heated debate on the long-term impact of this program. Initially, people were saying, oh, limited uptake of past initiatives, but they have been tried and they don't work. But what you see in the data is around 282 million people opened their bank account by March 2017. And in total, they were depositing around 630 billion rupees or $9 billion into their bank accounts. So that's a non-trivial amount of money that is going into their bank accounts. So this gives us a very nice lab to kind of study important questions of the scaling up of these kind of financial inclusion programs that have been tried across the world, but how well do they work? Initial uptake, subsequent usage of banking services, what are the impact on the broader regional economy in terms of credit and consumption. I'll skip this. There is a literature on financial inclusion that is mostly done through RCTs around the world or through theory papers, or actually some people have looked at some financial inclusion programs, I think one in Mexico and other places. Okay. So the data I will try to use to answer this question is essentially 3 data sets. We have a proprietary data set from the largest bank in India. We will use 1.5 million accounts that are specifically opened by the Jan Dhan Yojana people. These are really poor people who were opening their accounts from August 2014 to May 2015. I will also bring in around 50,000 non-Jan Dhan account holders who opened the bank account at the same time, but who are just above the cutoff to be classified as poor to be in this scheme. So I can have a comparison group of who opened from the Jan Dhan Yojana and who didn't. Then I have precise account level monthly information for these borrowers. I know their average balance, cash deposits, cash withdrawals, remittances, their debit card usage. So I'll try to study all of that. And then I also have very detailed demographics. Do they use mobile, education, district of residence, age, gender, and stuff. I will then bring in the regional economic data, the GDP data, financial literacy, population, lending, and other data sets like purpose of borrowing and consumption. Okay, just to give you some summary statistics of the people. So in India, clearly the minimum wage per day is around 89 rupees. Average wage per day is around 250 rupees. The poverty line in rural areas around 800. So the Jan Dhan Yojana, number of accounts opened through the Jan Dhan Yojana was around 282 million. They also gave around 220 million debit cards to these people. And the total deposits, as I said, from the macro statistics is around 630 billion Indian rupees. Okay. Now, if I look at the micro data, as I said, I have around close to 9 million account information on accounts and monthly account information. So they have around 1 million accounts and over a 1.5-year period. Then I can look at, for the Jan Dhan account holders, the average monthly balance is around $500. Okay. The cash deposits that are happening in this account is around 140, not dollars, rupees, is around 140 rupees. Cash withdrawal is around 160 rupees. Inward remittance is around close to 200 rupees. This is on a monthly basis. Okay. And you can see number of people who have positive balance is around 36% in the Jan Dhan Yojana accounts. People who have cash deposits is around 4%. Cash withdrawals is around 3%. So you can see activity month over month by the people in these accounts. If I look at comparable, these non-Jan Dhan Yojana or JDY accounts, obviously the numbers are much larger for them. So it's not completely comparable apples to apples, but I think the important issue is the trend. What is happening to the trend of the JDY accounts versus the non-JDY accounts? As I mentioned, if I look at extensive margin, which is the number of accounts open, there are 282 million by March 2017. And the key number there is the fraction of accounts with positive balance. And the highest number of accounts with positive balance are in the rural areas. Approximately around 36% of individuals maintain some balance in their account. The fraction is higher for older accounts and is comparable to national average for the JDY accounts. Okay, here is some other information on cash deposits and cash withdrawals and inward and outward remittances. And clearly these are important for migrant workers who are either working in big cities and they're remitting money to their families in the smaller cities. Some people could be even working abroad. If I break this data by some simple demographics like married and non-married, you can see some differences. Clearly, non-married people are transferring more than the married people, okay? If I start looking at the micro data, what is the effect on these bank accounts? Clearly, empirically, statistically, there are challenges because I have these treated sample of Jan Dhan Yojana account holders, but I don't know what they were doing prior to opening this JDY account. I mean, I have to assume it was zero because they didn't have a bank account. And then I have to start thinking, what is the counterfactual? So the only counterfactual I can come up with is looking at these non-JDY accounts who are slightly wealthier account holders, but they also opened the account at the same time and follow them over the 10 months. If I compare these two account holders, so what I'm looking at in these regressions is essentially account balance and account usage by Jan Dhan account holders relative to non-Jan Dhan account holders ex post, and average monthly balance by these people is actually going up by around 100 rupees per month, okay? If I look at log of this, it's around 29%. So the account usage is going up by 29%, which is quite significant, okay? So it's growing at the rate of around 4.5% per month. I'm looking at collectively, so it's around 29%. So which tells you that there is quite a significant impact on the usage of these bank accounts by the people once they open the account. Here is a graph that kind of simply shows what I just conveyed. The red solid line are these Jan Dhan account holders, and they essentially started from zero balance. So they're going from zero balance on average to around $1,200 balance within not dollars, 1,200 rupees balance within a period of 8 months. So quite a lot of savings are being generated by these people. Okay, I'll skip this slide. This kind of just tells you what is the econometric specification I'm using. You'll just trust me that it's pretty kosher. I'm doing a pretty good job in trying to compare the guys who are being treated compared to the guys who are non-Jan Dhan Yojana guys who are not being treated. This slide is just basically getting at who is actually benefiting. I'm looking at account age, gender, age of the age quartile, marital status, mobility dummy, and so on and so forth. Across, I'm not going to go over these numbers because they're quite dense. So I'm just going to give you the punchline. Married, older, and mobile phone owners have a significantly higher usage when they open up their JDY bank accounts. Here is another way to look at the data. What is happening to account usage as a result of crime? So here I'm trying to get at the three mechanisms that I was trying to tell you guys, that why are people opening up bank accounts? Why are they saving more money? Is it because they're worried that, crime could be driving this? And so I look at high crime per capita dummy and see, look, clearly people who live in high crime areas, they are more prone to using bank accounts and depositing money in these bank accounts. The second argument I had was about liquidity management. So do people do this because of positive liquidity management? So I'm looking here at some positive liquidity shocks. So one of the liquidity shock I have in mind is rainfall shock. When there is actually a rainfall shock, positive rainfall shock, do people then go take their money and put it in and deposit it in the bank account? So account balances increase during positive rainfall shocks month and month after, and decreases subsequently. So this is consistent with this idea that it is associated, a positive rainfall shock is associated with an increase in income, and that increase in income ends up going to be deposited in your bank account, okay? What about negative liquidity shocks? So I can also look at negative liquidity shock. Those are looking at Hindu marriages. So Hindu marriages in India are confined to certain time periods that are dictated by the priests and other people. So then the question is, when you have these negative liquidity shocks, do people start withdrawing money from these bank accounts? So clearly bank account balances fall during Hindu marriages and subsequent months after that. So Hindu marriages are clearly associated with increase in expenditures, or you can think about negative liquidity shocks. So these are kind of ways trying to explain why and how these bank accounts that are being created for the unbanked are being used. Why are they being used? They could be used because of some crime-prone issues, or they could be also used because of some liquidity management issues. The third idea we had is, does access to credit actually cause people to go out and start depositing money? For instance, I realize that if I have deposited money in my bank account, does that cause me then to get access to credit availability through the banking channel, the formal banking channel? And we find that gender, marital status, age, and mobility is clearly associated with higher likelihood of you getting access to credit if you deposit your money into your bank account that you just opened through the JDY accessibility. We were trying to look at access to credit around liquidity shocks. Are they correlated? Now I'm trying to correlate some of these ideas together, access to credit and liquidity shocks. So are banks more likely to give you a bank account? So here, the punchline here is conditional on getting a loan. Loan demand is lower in the months immediately following the positive liquidity shock, which makes sense. You're getting a lot of cash because the heavy rainfall gave you a big crop. You don't need to go to a bank to get a loan from a bank anymore. But conditional on getting a loan, loan demand is higher in the months leading up to the Hindu marriages. So again, when you have a negative liquidity shock, you clearly want to get more access to credit from the banks. So the banking channel and the liquidity channel kind of interplay with each other in your reason to use the bank account through the JDY and use your ability to get access to credit through that. Okay, we did a lot of things on the regional analysis. I will try to be quick on this. We were trying to look at the number of adults per bank branches, how they actually fared, percentage of state-owned bank branches, fraction of households with bank branches. So here is the exposure of the JDY across India. So this gives me variation regionally on how many people across India over these regions actually tapped into JDY. So in some regions, very few people actually had JDY bank accounts. In some regions, many people have JDY accounts. So that variation I will try to exploit in trying to understand, does that variation in access to JDY had any impact on credit availability, consumption volatility, debt, and other outcomes? Okay, so basically this is very, very simple, trying to understand program intensity or JDY exposure and program intensity. And what we find is a 1 standard deviation increase in adults per branch is kind of associated with around 65% increase in bank accounts opening. I'll show you some bank lending results. Here is a result that is interesting. A 1 standard deviation increase in the exposure to JDY for that region is associated to around 1.2 to 2.6% increase in bank lending. So the more you had people who had a JDY account in your region or in your district, the more likely the bank was willing to extend credit to people who had a JDY account. So clearly having a bank account helps you get credit from the formal banking sector. Obviously, defaults will go up. Anytime the bank is giving credit, the credit is going to the marginal borrower in that region because the JDY borrower is the marginal borrower, and that marginal borrower is the more risky borrower, and the banks are taking on the margins slightly higher default rates on their portfolio. As I said, if they're pricing it correctly, so be it. Okay, so the way I interpret this is that capital constraints Why are the banks doing this? Is it because banks increase lending due to additional capital from these new deposits? Or is it because of the unmet demand for formal credit? Clearly, my interpretation of the data is that there is this unmet demand for formal credit. And this goes back to Siddharth's whole presentation that, look, there are lots of people who are unbanked, and unbanked will get them access to credit. And not because they will get access to credit because banks feel like, now I have more deposits, let me give it out. No, it's because the banks realize there are too many people who need credit, who are credit worthy. And by having a deposit account, they become credit worthy. And I'm now willing to give them credit because it's profitable for me. And that's a key mechanism that we are trying to highlight in this paper, that why banks are willing to do this. There are lots of other results I have. I don't know how much time I have, but I will, Perry, to have few minutes, or because I want to talk about the two other ideas. So let me just talk about borrowing. I mean, borrowing clearly goes up by the people in these exposed places. And health and medical expenditure also goes up because they have the ability now to borrow money from the banks and use their savings. So people are taking better care of their health, and they're buying more medicine because the access to credit. This is the final result from this paper, which is about consumption smoothing. People are able to smooth their consumption more because their food expenditure now is not as volatile. The standard deviation of food expenditure goes down by almost half. So what used to happen, they would buy a lot of food one month, and next month they were not able to buy a lot of food. That obviously had implications on their health, but also storage and other things. But now, because they have this bank account, they can better manage how much food they need to buy month to month because they have savings in their bank accounts. Okay. Let me stop this presentation here and broadly talk about the two other ideas. Especially, we kind of use the same idea in Rwanda, where the Rwanda government actually allowed people to open in their entire 400 districts, gave access to credit to the people who didn't have access. And what this did is allowed consumers in those districts to then use this access to banking to go to the formal banking sector and ask for loans. I can put up all these three papers. Later, I can provide access to all the three papers. There you can go in detail and to look at everything we have done. Let me quickly also talk about this other paper, which is about the Korean maids. So we actually have a data from a fintech company in Korea. And what we have there is the entire data of how the maids were using this fintech app to transfer money back to, say, Philippines, Indonesia, Malaysia, and wherever they are coming from. Typically, they would just, in the old time, they would just go to a bank or an intermediary, and the intermediary will charge them huge amounts of fees to transfer money back home. This fintech company said to them, there are two features that are important in this app. One is you can transfer the money anytime you want. It could be in the middle of the night. It could be anytime. You can go in the app and they give you the exact exchange rate that they will charge you when you transfer the money. The second feature that they gave is they said, look, if you transfer the money and for some odd reason you feel that this is not the right time and the exchange rate you are getting is not favorable to you, then you can cancel your transfer. And once you cancel your transfer, you can come back and redo that transfer the next day or in 3 days or in 5 days. What we see in the data is the maids quickly started forming networks among themselves. And so the Filipino maids who come from one city would form their networks on this app. The Malaysian maids who come from one city, they form their own networks, and they would tell each other that, look, this is the right time because I'm getting this exchange rate. and all the maids will transfer at the same time. But if one maid send a message, look, this exchange rate is too high, I think tomorrow the rate will be better, they all will immediately try to cancel their transfers together, and then they will transfer again another day. So these two features really help the maids. The first thing that was surprising to me is maids are not that educated, understanding exchange rates, exchange volatility of exchange rates is very complicated, even for economists who have spent a lot of time thinking about this idea. But the maids got it immediately that using these features of cancellation and forming networks was allowing them to optimize through this fintech app on when and how much money to transfer to each other. I will stop here because I can go on, but if there are questions, I'm more than happy to take them on in the Q&A. But let me take a break.
Thank you, Sumit, for the excellent presentation of the works on the empirical works, the banking account, as well as how to reach out the unbanked people. Of course, I'm just wondering, bank account vis-a-vis digitalization using QR Indonesian standard, in a QR or whatever, UPI, whatever, on the digital, apps and so on, how will be impact on the result. So next, our man of the hour is our two distinguished panelists, my fellow Governor Yigang and former Governor Dufuri Subaro. Governor Yigang from the People Bank of China. He was the governor of People Bank of China since 2018. I do believe he was appointed governor of the People Bank of China in March 2018 to be exact. Governor Yi received a PhD in economics from the University of Illinois in 1986 and was a faculty member in the Department of Economics, Indiana University from 1986 to 1994. In 1994, he co-founded the China Center for Economic Research at Peking University and has been a professor at CCCR since then. His research interests including money, banking, and Chinese economy. But of course, since then, Governor Yigang career in the government, including at the People Bank of China. Of course, our the second panelist I will introduce later on. I will now invite Governor Yigang, but because Governor Yigang it is unfortunate that Governor Yigang is not able to join us live tonight, but he has kindly pre-recorded his remark. So we will start first. Governor Yi's video, please, to be put. Thank you.
Thank you, Zeti and Augustine, for inviting me to this ASBxBIS conference on digital disruption and inclusion. The increasing adoption of fintech is one of the most significant features of the financial sector in recent years, changing the rules of the game. New technologies have been deeply integrated into financial services, giving rise to new market players such as fintech companies and virtual banks, and the new business including mobile payment and fintech credit. Well, guiding market players to use these fundamental change to improve efficiency and financial access, regulators should also prevent negative effects. Fintech has been developing rapidly in emerging market economies in Asia. A large unbanked or underbanked population in Asia has high demand for financial services, while high internet penetration rate has made this possible. Innovations have been observed in many Asian EMEs in areas such as payment, credit, wealth management, and so on. The BIS has conducted a lot of research on fintech to explore best regulatory practice. Today, I'd like to share with you China's experience on fintech for financial inclusion. First, mobile payment. Mobile payment could serve the long-tail customers that cannot be covered by traditional financial institutions. At present, China's mobile payment penetration rate is about 86%. Providing real-time services of deposit, cash withdrawal, and money transfer to over 1 billion people. In the ongoing eCNY pilot program, the People's Bank of China has made special arrangements to bridge the digital divide. We have facilitated a digital wallet for the underbanked groups, such as students and people in remote areas, and tailored an eCNY card for the elderly people and people with disability. At the upcoming Winter Olympic in Beijing, athletes from around the world will be able to experience eCNY. Second, access to financial services. Empowered by technology, financial institutions can digitalize the whole process of credit approval and risk control, so that they can provide faster services at a lower cost and reduce reliance on collaterals. As a result, the frequent and urgent need of small and micro business for small amount loan can be better met, facilitating a stable increase of SME loans. By the end of 2021, about 19 trillion yuan credit was extended to about 44 million small and micro business. Some financial companies have launched online wealth management in collaboration with big techs to improve transparency, reduce costs, and meet the investment need of lower income groups. With the support of big data, many insurance companies have introduced new products like freight insurance and flight delay insurance to adapt to people changing lifestyle. Now, I'd like to share with you some of my observations. First, delicate balance needs to be struck between development and regulation on fintech. The rapid rise of fintech has exposed many problems such as financial risk, market monopoly, and privacy protection. Therefore, since the end of 2019, efforts have been made to improve the regulatory framework on fintech. All financial activities must be licensed and regulated. And internet banking, insurance, and fund management business must comply with prudential requirements. More efforts have been made in antitrust. With the announcement of the anti-monopoly guidelines for platform economy, we recently published the Data Security Law and the Personal Information Protection Law. And the regulations on personal financial data protection are also in the pipeline. Second, we need to closely monitor the impact of fintech on small banks. There are more than 4,000 small banks in China. They are at a disadvantaged position in terms of capital, customer base, and technology. But these are grassroots banks, and they have a comparative advantage in serving local customers. To survive and thrive, they need to focus on improving basic financial services for their grassroots customers they know well. Third, a top-down approach could help harness the power of fintech. While sticking to market orientation and respecting property rights, we have also improved the institutional arrangements to address issues that are beyond the market power. Recently, the People's Bank of China issued the FinTech Development Plan 2022 to 2025 to guide the fintech sector's support to financial inclusion and the green transformation. To conclude, promoting financial inclusion is a common goal shared by international community. China is willing to work with the rest of the world to explore the optimal path of using fintech to promote financial inclusion and to narrow the digital divide. Thank you very much.
Thank you, Governor Yigang, for sharing the Chinese experience on the fast growing of the fintech, serving the financial inclusion as well as digital financial services fast growing in China. Yet there is also some issue of the regulatory as well as on how to balance between the speed of innovation as well as the customer protection, market competitiveness, as well as data privacy. And we are also really how the good progress of the regulatory that being also introduced in China, whereby all of the fintech, the license, as well as also following the principle of the prudential on the financial as well as payment services. We will also have a speaker also from my dear friend, Governor Duvuri, which is also serving as governor of the Reserve Bank of India. for 5 years, 2008 to 2013. Prior to that, he was finance secretary to the government of India, 2007, 2008, and the secretary to the Prime Minister Economic Advisory Council, 2005, 2007. Governor Subarao went to graduate school at Ohio State University, and also later was a Humphrey Fellow at the MIT studying public finance. So without further ado, I will invite Governor Dufury for your, of course, sharing on India experience or your thoughts on how the digital innovation can benefit financial inclusion. Governor Dufury, please.
Thank you. Thank you, Governor Perry. 40 years ago, in villages across India, when parents were looking for a boy for their daughter, one of the first things they would check is if the boy's village has a drinking water source. That's quite understandable, because if there was no drinking water source, they would condemn their girl to a lifetime of drudgery. 20 years ago, when in villages across India, when parents were looking for a boy for their daughter, what they would look for is whether the boy's household has a toilet. Over the last 10 years, in villages across India, what parents are looking for when they look for a boy for their girl is whether the boy has a mobile money account. That is an illustration of how consciousness about financial inclusion has increased as a result of digital technologies. Siddharth Tiwari has given us the macro view, the global view, as well as the Indian view about how technologies have disrupted finance, how that can be a win-win option, but how we've got to guard against risks. My good friend, Professor Sumit Agarwal, a diligent researcher, has dived deep into data to show us behavior of people at households at the micro level. I struggled hard to determine what I should say. And what I thought I would say is 3 points. The first point I want to make is this. What is unique about India's digital technology-driven financial inclusion? It's been a magical revolution over the last 15 years, particularly over the last 5 years. The first is the JAM Trinity, J-A-M. J stands for JDY account that you heard already from Siddharth and Sumit. Jan Dhan account, which is a no-frills account, no minimum balance required, low KYC requirements, and people were encouraged to get a JDY account. But there was no response. People were not interested. But then something magical happened 7 years ago, when the government said that we will transfer all government payments to people through the bank accounts, whether it's subsidy, pension, scholarship, wages, whatever. Immediately, demand for JDY accounts exploded, quite understandable. The second leg of this trinity is Aadhaar. You heard about that already, but let me say it in my own words. Aadhaar is a 12-digit unique identity for every resident of the country, based on biometrics, iris, and fingerprints. Just look at this. In a country of 1.4 billion people, low literacy levels, high poverty levels, low awareness levels, where nearly half the people do not even have a birth certificate, giving a digital identity to nearly 1 billion people was by far the largest enumeration exercise ever in the world. Very, very magical, astonishing achievement. The third leg of that is M, which is a mobile phone. 7 years ago, even 5 years ago, the fear was that the cost of mobile phones would come in the way of financial inclusion. But mobile phone prices crashed because of Chinese models or Indian-made Chinese models. And internet prices in India are among the lowest in the world. And the government is laying fiber optic cable across 600,000 villages in the country. So digital technologies have enabled this jam trinity to come together. Each one of them by itself would not have produced a revolution. It was somewhat serendipitous that all three of them came together at around the same time and triggered this revolution in India's financial inclusion. As we say, for a long time, nothing happens and suddenly everything happens. That's what happened with India's financial inclusion revolution. The second unique feature of India's financial inclusion is that the government, under the Reserve Bank, insisted from the beginning that digital infrastructure will be created as a public good by a public corporation. On top of that public infrastructure, apps can be built. This is quite different from what happened in other emerging markets, where telecom companies, technology companies laid the infrastructure and they were lending it to others. In India, that did not happen. There was a public sector corporation which laid the infrastructure and allowed private sector to build applications on that. What's the benefit of that? The most important benefit of that is that it made systems interoperable. QR codes. Now, of course, all over the world, it's, QR codes are common for whatever system you use. But India, even 10 years ago, we had a common QR code. And public infrastructure also avoids the cost of monopolies. The fourth unique feature of India's financial inclusion is safeguards from the beginning about or against money laundering, AML, and CFT. For example, just to give you an example, India insisted right from the beginning that for every payment transaction above a certain limit, there must be a bank at either end of the transaction so that every transaction can be tracked. The fifth thing, very important, is emphasis on consumer protection. We all understand that a program like this, if consumer confidence is lost, it can get derailed and derail a potentially promising program. So India insisted on consumer protection right from the beginning to avoid the backlash. To give you some examples, non-bank finance companies were mandated to hold all their money in escrow accounts. Similarly, telecom companies operating or giving financial services were asked to tie up with a bank. There was limited liability of consumers for transactions on digital platforms. And there was a separate ombudsman for digital transactions. The second last unique feature, excuse me, of India's financial inclusion is closing the gender gap. Both Siddharth and Sumit referred to this. What digital technologies made possible was to give accounts to women. Earlier, there was one account for household, and quite expectedly, that was in the name of the guy who would use the money, who had access to all the money, who would use it for drinking and for wasting away and starve the wife and children. What digital technologies did is to empower women, give an account to them, because they have an identity of their own. And the government also said that subsidies and wages and pensions to women will be transferred to their own accounts. And biometric identity ensured that the guy cannot snatch away that money because the woman's biometric identity was necessary to withdraw money. So one of the remarkable things about digital technology-driven financial inclusion is closing the gender gap, which empowered millions of women across the country. The final unique feature of India's digital technology-driven financial inclusion is that 1,000 flowers bloom. India is a large enough country. So instead of regulating one model or one idea the government and the Reserve Bank said, decentralized levels, they can experiment, do whatever they want. Whatever succeeds, we will mainstream across the country. So these are some of the important features, unique features that made India's financial inclusion revolution magical. The second comment I want to make is about digital technologies have transformed payments. Can they similarly transform credits? We know that payments have been the entry point for fintech and techfin, whether it's internet startups which tied up with financial companies and provided services, or technology companies which are providing financial services, fintech or techfin. They came and disrupted the payment system. Banks were making fat profits. They competed that away. As a result, cost of payments has come down, both cross-border payments as well as domestic payments. I understand the UN norm for transfers is 3% of the amount, that the cost of transfer cannot exceed 3% of the amount. I don't think we are there yet, but over the last few years, the cost of transfers has declined significantly and quite steep. And digital technologies have deepened access and reduced the cost of payments. But the point is this: financial inclusion is more than just payments. Financial inclusion is credit. Financial inclusion is savings. Financial inclusion is microinsurance. Can digital technologies in particular ensure that low-income households who have these bank accounts, can they get credit? Because access to credit, we know from development experience, is a sure short way of improving opportunities for sustainable income improvement. But we know historically, banks have been reluctant to lend to poor households. They did not consider them a lendable risk. They did not have a collateral. So as Bob Hope once said, you get a loan from a bank, you have to actually prove to a bank that you don't need a loan. But poor people could not do that. The banks also found the last mile connectivity cost very high. So the cost of credit was high. Then about 40 years ago, microfinance came. It originated in Bangladesh, spread to India, mushroomed across the country, and then spread to South Asia, and now it's all over the world. Microfinance bridged the gap between commercial banks and poor households by lending. And microfinance was an astonishing revolution, lifted millions out of poverty, even as microfinance institutions made millions. But the problem was that the cost of microfinance loans was high. Why is it high? Because the ticket size is small, and the cost of pricing, disbursing, monitoring, recovering the loan can be high. As they say, it's expensive to be poor. So there was, in fact, in our country, in India, a backlash against the high interest rate microfinance was charged. The question is, can digital technologies help reduce the cost and widen access? And I believe that's possible. In particular, digital technologies can do two things. One is reduce the cost of transactions, the legwork and the paperwork required, so that the cost of credit comes down for poor households. And the second, more importantly, is to use digital technologies to build a credit history, even for people who've never had a footprint in the formal financial system, who had no credit system, who never took a credit, who never had a credit history at all. For example, today it's possible with digital technologies to track people's shopping pattern. How regularly do they shop? What do they buy? Which is an indication of the steady stream of their income. If a woman is actually buying female hygiene products, is an indication of pregnancy. If you're charging your phone regularly, it's also an indication of regular income. Now, some of these companies also give nano loans to poor households, $2 or $4, to build credit histories so that they can get larger loans from commercial institutions. And the important thing is banks or microfinance institutions are concerned about ability to pay and intention to repay. And I believe digital technologies have the potential to give better understanding of an individual's intention to repay and ability to repay. I have one more slide. I'll take 2 more minutes. I hope I have your permission, Governor Perry. See, the last point I want to make is this, that every paper I've read on CBDCs, central bank digital currencies, says that one of the objectives or one of the byproducts of CBDCs will be financial inclusion. I'm not persuaded by that argument. The reality is that many poor households, as Augustine Carstens said in a BIS speech, already have access to fast payment networks. So the question is, when CBDCs come, can they make payments deeper? Can they make them cheaper? Can they make them faster? I don't believe so. Consider deeper, for example. Even to enter a fast payment system, an individual today has to pass a minimum KYC requirement. There is no reason to believe that just because we'll transit from a fast payment system to a CBDC, the KYC requirement will be diluted any further, which means that people who are left out of fast payment systems today will likely be left out of CBDC systems as well, simply because they will not be able to meet the KYC requirement. Will CBDCs make payments cheaper? The point is this, even today, the cost through digital transactions, most of the time they're invisible. It's paid either by the 2 parties or the platform. Again, there is no reason to believe that when CBDCs come as a single-tier system or a 2-tier system, there is no reason to believe that central banks will absorb this cost. So I don't think they'll be any cheaper. And finally, I don't think they'll be any faster either, because for most poor people, in fact, for most people, they're quite happy with the speed of current payment systems. I don't see what they can do with faster payment systems. So I don't believe that the argument that CBDCs will deepen financial inclusion has much weight. I'll stop there. Thank you very much.
Thank you very much. I think our discussion has been fast, reaching. We started with Mr. Tiwari outlining how the opportunity for digital innovation for inclusion. We did a number of effort on how to use digital innovation for inclusion. We talked about the need to reach out the unbanked with ID, biometric, but we also need to integrated payment system. We need about transformation of digital banking, virtual banking, the data, as well as the regulation. Professor Matt already also explaining the empirical, how the digital as well the unbanked can be reached out and make the benefit for the transformation. We go on with the regulatory approach, how Governor Yikang also introduced the fintech regulation, so that the benefit can be matched with the risk mitigation, customer protection. And we just now hear how actually the regulatory approach need also to be strengthened with Governor Barrow experience on the need for the customer protection, KYC, on the digital transformation, but beyond that, also how the regulatory to also address the market monopoly. So the cost of efficiency of digital transformation, digital innovation, indeed benefit for the inclusion, low cost. But beyond that, also talking about the future of digital central bank digital currency. Will it also serve the benefit of inclusion? Maybe no. Maybe not. I think this is a very fruitful discussion. So we have time for Q&A, and the Q&A box, there are a number, so many, but as chair, I have the authority to choose to choose which actually the question that I will pose. This is a two question, which is actually need also to be discussed. The first is the question from KI MCB something something. I do not know who the person is. The question is, while digital revolution would propel inclusion initiative, the need to have proper and advanced infrastructure is a key, and this is also an issue. However, the necessary authorities in some jurisdictions have yet to catch up with such a rapid revolution, including on the rollout of the 5G tech is still slow in certain corner of the globe. How would such noble initiative of the financial inclusion by central bank across the world can be achieved when the other relevant institutions within the public sector do not play their role effectively? Well, this is a very hard question. The second question is from Duanyi. The question is, while promoting digitalization, how can regulation and supervision manage the risk of monopoly, systemic, and too big to fail fintech or technology finance? I think this is the question. The first is about the infrastructure. Will it be left to the private and then, inducing monopoly? But of course, the public sector, the government, the state, need also play a role on the building the infrastructure for the digital transformation. And the second about the market structure, the risk of monopoly, systemic, and too big to fail fintech. I will invite all speakers. Siddharth, you want to start? Or Governor? I will let Governor JD, the last one. So I will invite Siddharth, please. You can take the first question or second question, whatever.
Yeah. So I think, as Augustine said and Subha had said before, that the role of the public sector, it is an important role of the public sector to provide the infrastructure. The internet was developed by the public sector in the United States and then provided to the private sector. The GPS was developed by the public sector and then provided to the private sector. So there is no reason why the public sector should not be providing the foundational rails. The central bank for the payment system, the government for mobile distribution, and that is the responsibility of the public sector. And on, I think, on the question of both
monopoly,
too big to fail and monopolies, and whether it is activity versus entity, I think two approaches have gone hand in hand. That the principle of activity-based regulation is same activity, same regulation, and it is applied to ensure that virtual banks or digital banks are not an avenue for shadow banking activities and regulatory arbitrage. But on the other hand, they pose two additional risks, which is the diversity of firms that own and control them, big techs and fintechs, often with no previous experience in banking, and the data and the technology-based business model that requires the regulatory framework to be extended. And this type of regulation is clearly more entity-based than activity. In Hong Kong, there's an additional requirement that the virtual banks have to present a plan to wind down without financial instability, without causing financial instability. So integrated regulatory approach that is risk-based, that is technology neutral, is likely to succeed.
Thank you, Siddharth. I will invite if Professor Agava want to say, but of course I will invite Governor Subaro and then Governor Aziz. I will speak at the end of Indonesia experience on the infrastructure and market monopoly. Because of the time limited, can you just a quick respond? Sorry, please.
Thank you. So I think I really think of this question on the role of infrastructure and banking or access to banking. So here I've actually looked at this very carefully in India. The question is very hard to make causal inference on this. So the area I looked at it was the road construction in India, which is also infrastructure to the villages. And because roads in India were constructed at these cutoffs of 500 villagers versus 1,000 villagers and 250 villagers. So that allows me to cleanly see if access to roads brought banks. So I have two different papers on this topic. One is, it's called Roads and Banks, and we actually show that road construction brought banks to the village, that brought access to finance, that brought access to lending, and a lot of good things happened to the villagers. The second paper, which is titled Road to Stock Market Participation. And we again look at the role of roads in India, because again, I'm very interested in causal inference. So I have to be able to show it is because of roads and nothing else. So there we actually can show using the NSC data, which is the entire data of individual stock market participation for all of India, show how access to roads in these villages and small towns actually brought people to do investing in the stock market, and they were participating much more aggressively. So I clearly think this is an important issue. Now, 5G and other things are very hard to study empirically to show they can cause access to banking and access to finance, because there is no clean experiment to do that. But I'm guessing since I can find evidence on roads, there must be evidence elsewhere.
Thank you. Governor Subaro, please. Governor
Thank
Subaro?
you.
Yes, please.
Yes, thank you, Governor Perry. I want to address your question about regulation. I want to give a broader response and then a more narrow response. My broader response is this: the perennial challenge for regulators all the time, everywhere, is to draw the right balance between regulation and innovation. They don't want to regulate so tightly that innovation is squelched. At the same time, they don't want to run a laissez-faire regime because it'll destabilize the financial system. Drawing the right balance between regulation and innovation is always a challenge. It's a particularly acute challenge in the case of digital technologies, just because there is so much of lack of knowledge on either side. Regulators don't understand technology. Technology companies don't understand regulation and finance. So I think going forward, there has to be emphasis on bridging this, on bridging this gap. Having some people in central banks and other regulatory agencies, some people who are well-versed in technology, and in technology companies have people who have knowledge of finance. I think that's very important where digital technologies are concerned. Now, I want to give a more narrow response, which is about regulating institutions which are involved in financial inclusion. No matter what institution it is that is doing the final lending, whether it is a microfinance company, whether it's a technology company, whether it is a non-bank finance company, the source of money is the banks. And it's banks and banks alone which are allowed to take deposits. That's true of India. I believe it's true of most other countries. We don't allow non-bank financial institutions to collect deposits. So as long as other downstream institutions are taking money from banks and lending it, it's important that lending by those downstream institutions is regulated as well, because they are actually sourcing money out of deposits. So it's very important to ensure that no matter what the last mile institution, as long as the source of money is the banks, they're regulated quite tightly. Thank you.
Thank you, Governor Subaro. This is indeed. First, if we talk about the infrastructure in digital, there is two kinds of the infrastructure, which is satellite, 5G, and so on. I think indeed, see that right. This is the role of the state. But if we talk about the payment system, not only the satellite technology, but also payment system infrastructure. This is also, there is some role for the public. In Indonesia, the building of the fast payment is from the central bank. We also building real time gross settlement and a number of main systemic infrastructure of payment we develop from the central bank. Why? This is also related to the second question. The more of the technology and infrastructure be left by private, then by nature, market monopoly will emerge. Because at the end of the day, the private will need to have a return on investment. Where's the return on investment being charged? To the customer. I think this is where actually the thing that we have to think about developing the digital innovation. Governor Subaro mentioned, and see that also right. Whatever, then there is a role of regulatory. How to develop the innovation, security, but also market efficiency for the digital innovation to benefit for the financial inclusion. I think this is a very fruitful discussion. Dr. Zeti, Agustin, Governor G, Governor Duforay, also Mr. Siddharth Tiwari, Professor Subir Agrawal. This is excellent session, and hopefully this is laying down the good ground for the next session. Thank you all for the very kind presentation and discussion, and I hope the session is enlightening as it is for me. For all of you present, very good night. Thank you very much.
Thank you. Thank you very much. Wonderful.
Thank you, Governor. Hello, my name is Rich from Cambodia. I am part of the student in the Master of Central Banking program at Asia School of Business. Today's session provides an insightful discussion about how technology development promote financial inclusions. I hope you enjoy it like I do. I would like to reiterate thanks to the speaker, panelists, chair for the great discussions, and would like to give you a preview of tomorrow's sessions. Tomorrow, the topic is financial resilience. We have a special address by Her Majesty Queen Maxima of the Netherlands, the United Nations Secretary General's Special Advocate for Inclusive Finance for Development. Governor Benjamin Jokno from Bangko Sentral ng Filipinas will be your chair. We will have two speakers. Dr. Leora Klapper from the World Bank will talk about financial health and resilience. We will have a slide change in the program, and Mr. Dilip Asbe from National Payment Corporation of India will talk about India's digital payment system. As panelists, we look forward to hearing from Governor Setuput Sutipat Neruput from Bank of Thailand and Professor Hyun Song Shin from Bank for International Settlements. Good night, keep safe, and look forward to see you tomorrow. Thank you.